Good morning. Hello. Good morning.
Good morning, madam.
Okay. Benedict, are your people here?
Madam, we are here.
Oh, okay. Okay. So meaning we can start now. The
Yes.
people from other centers are not here. But you let's start. So this is unit 3. And we are looking at the analysis of statements of financial position and income statements. Benedict, you can mute yourself. So last week we looked at reformulation of statement of shareholders' equity as well as the cash flow statement. So today we are channeling our view to the income statement and the statement of the financial position. So reformulating shareholders' equity allows us to measure overall shareholder profitability. And together with growth, the profitability determines the residual earnings and the firm value. So to understand profitability, financial statements must be reformulated. So as we established last week, you have to separate operating activities from financial activities. And since only operating activities create values, understanding and correctly classifying these items is essential to valuing the firm and understanding its business. So you have to note that the statements of financial position and the income statement are very pertinent statements that shows us the sources of profitability and the growth of a firm. And the aim of reformulating the statement of financial position as well as the income statement is to discover the return on equity and growth in preparation, which will enable analysts and the various stakeholders in their forecasting and their valuation. So this discovery is made through ratio analysis, combined as always with a good knowledge of the business. So when we say reformulating the statement of financial position, what comes to mind? So as we've established earlier, is reorganizing the statement so that we'll be able to know the operating activities from the financing activities. So reorganizing the firm's financial data, that's the reformulation, so that business activities are clearer, and it helps analysts understand firms better, and it reveals how it really operates. So by incorporating information from footnotes and disclosures, the reformulation of the statement of financial position provides more detail and a full picture of the firm than the standard published statement. So we ask ourselves, what are the points to consider to perform a good analysis of the income statement and the statement of financial position? So the first one is why the analyst reformulates income statements and statements of position. The second one is how knowledge of the business is incorporated in the reformulated statement. The fourth is how operating and financial components of the two statements are identified, how comparative, common size and trend analysis of the financial statements are done, how the elements of cost and sales are analyzed to measure the changes in income, why different methods and models are used in order to predict distress, and then how off balance sheet items are categorized. So this is the reformulated statement of financial position for Obri Ebua Company Limited. So from here, the particulars, we have non-current assets, net current assets, which is made up of current assets and current liabilities. So for the current assets, we have current investment, inventories, trade receivable, cash and cash equivalent, short-term loans and advances, and other current assets. So all this will give you the total current assets. And then we'll move on to the current liabilities, which is made up of short-term borrowings and trade payables. Other current liabilities, short and short-term provisions. So to get the total current liability, the summation of all these liabilities, and we classify it as B, and the summation of all the current assets are classified as A. So to get the non-current assets, it is A minus B. That's your current assets minus your current liabilities. That's what will give you the net non-current assets. Please, are you following?
Madam, we are
Benedict,
following. Madam, we are
Esmond,
following.
are you there? Okay, Esmond, Esmond,
Madam, I'm there.
are you following? Are you the only one though? You are there with your people?
I'm there with my people.
Okay, I can see other people have joined. Okay, Albert is here. Husseini, Mohammed, Mumuni, Orlando, Sansa, and Sul. Okay. So if you have any answer, you raise your hand so that we address it. So that gives us the net current assets. Then for the net non-current assets, we have the summation of non-current assets, which is made up of tangible assets, intangible assets, capital work in progress, intangible assets under development, non-current investments, deferred tax assets, long-term loans and advances, and other non-current assets. So the summation will give us D. Then moving on to the non-current liabilities, we have long-term borrowing, deferred tax liabilities, other long-term liabilities, long-term provisions, and then the summation will give us E. So to get the net non-current assets, it will be the non-current assets minus the non-current liabilities, and that's D minus F, and that will give us F. Then we'll move on to share application money pending allotment. That's minus J. So the C is the net current assets, the F is the net non-current assets. Then from that we subtract J, which is made up of the shareholders fund represented by share capital. And I know you understand all this because we looked at them when we were looking at shareholders equity. And we have share capital, reserves and surpluses, and money received against share warrants. So this is a pictorial view of the reformulated statement of financial position. And as we've said over and over again, this is not to, how do you call it, manipulate the statements of financial position, but to arrange it in a way that is clearer and more understandable to the various stakeholders of the organization. Then we move on to reformulating the income statement. So it involves combining profits from continuing and discontinued operations to capture total performance for analysis. However, in Ghana, financial statements are already structured in a way that supports such analysis. So in Ghana, the companies structure their statements of financial position and income statements in a reformulated form already. So there's no need for you to do reformulation. However, in other jurisdictions where disclosures are more extensive and complex, reformulation is required to clearly separate operating performance from non-operating performance. Please, any question at this point? Any question?
No question, no question. Let's proceed.
Hey, 1%. So meaning I can ask you a question.
Yeah, yes, madam.
Yo, please, who is speaking? Because there are many there. Who is speaking, please?
Madam Jennifer is speaking.
Who?
Jennifer. Madam Jennifer is
Jennifer.
speaking.
A guy is speaking and you're saying Jennifer.
Yeah, yeah. It was hilarious.
Yo. So we move on to the reformulated income statement for the same Obri Company Limited. For A, that's operating revenue, that's revenue from operation. And then B is operating expenses, which is made up of cost of materials consumed, purchases of inventory, changes in inventory of finished goods, that's work in progress, employee benefit expense, depreciation and amortization expense, and other expenses. So operating income before tax is what? A minus B, where A is what? Operating revenue and B is operating expenses. So you subtract the operating expenses from the operating revenue to get operating income before tax. Then taxes on operating income is made up of current tax and deferred tax. And to get operating income after tax, you subtract. Okay, so let's make it C here. Operating income after tax. Then other operating income before tax is made up of items, taxes on other operating income, where we have current tax and deferred tax, and other operating income after tax. So to get your total operating and other operating income after tax, it will be your E. So E is equal to C, which is the operating income after tax, plus D, that's other operating income after tax. So the summation of C plus D will give you E. Then for financing income as an expense, other income related to financial activities and financial costs will give you net financial income after tax. Yes, Joseph,
Good afternoon. Hello, madam. Good afternoon.
I'm listening. Afternoon.
Yeah, sorry. Please, I don't know whether it's from my side. I can't see what you are sharing. What you are projecting, it's not shown here. I don't know whether it's me alone or the rest.
The others, can you see
I
my
think it's you
screen?
alone.
I don't know.
We can see.
Can you see my screen?
We can
Yes,
see.
madam.
Hello.
Your screen.
Yeah, we
Okay,
can see your
thank
screen,
you.
madam.
Okay, this is a reformulator. It is a format. That's what I'm going through with you. Hello. Then for the taxing on financing income, we have current tax and then deferred tax. And then for the net financing income after tax, to get the then we have net financing income after tax, that's F. So to get profits after tax for the year from continuing operation, it is G is equal to E, where E is, you remember what we did here, E is C plus D, and C is operating income after tax plus other operating income after tax. That will give us E. So to get the profit after tax for the year from continuing operation, it is E plus F. We'll move on to, so to get your profit or loss from discontinuing operation, it is profit or loss from discontinuing operations and tax on discontinuing operations. Then for your profit or loss for the period, it is G plus H. So that is the reformulated income statement for the year ended December 31st for Obri Yeboah Company Limited. So this is the form company. Yeah. Joseph. Joseph.
Hello, madam. Hello, madam.
Yes. I'm listening, Joseph.
No, I've not.
So this is the format companies follow in reformulating the income statements of their firm. Is any question at this point? Hello? Any question? Yes,
I don't know because it's a format we are following.
Okay, I hope you understand it.
Sure.
We move on to comparative financial analysis. When we say comparative financial analysis, what comes to mind? Who will help me? Comparative financial analysis. Hello? Can you hear me?
Yes, madam. Hello, madam. Hello?
Yes, what is comparative financial analysis? Any other person?
Okay, financial performance with another year or a current year
Joseph,
financial performance with previous years. Yes.
please come again. Your network, we were not getting you. Please come again.
Okay. I'm saying that comparative financial yes.
Okay, thank you. Awal, is it Awal? I saw Mohammed Awal. His hand was up.
Yes,
Yes, Mohammed.
madam. Yes,
You want to
exactly
help
as
us?
you said, about comparing the financial performance of a business year in, year out. Whether two or more financial position of a business.
Okay, thank you, Mohammed. So as your colleagues have said, it is comparison could be done within a company. That's intra-company analysis or intercompany analysis, where the company is compared with another company or with the industry they find themselves. So comparative financial analysis is recasted for comparing all elements of financial conditions from year to year in absolute term as well as in percentage. And then recasted statement is called financial statement analysis. So this statement is made by showing absolute money values for each element of income statement and statements of financial position at different periods, showing increase or decrease in absolute money value of each element by deducting this period, showing increase or decrease in terms of percentage, that's increasing or decreasing amount over amount in the past times 100%. So keeping in mind that the principles and procedures followed in the collection and presentation of data should not be materially different over the periods. So then we move on to the advantages of comparative analysis. When you do comparative analysis as a firm, what benefit do you derive from it? So first, figures for two or more periods are placed side by side to facilitate inter-firm comparison in horizontal analysis. It brings out more clearly the nature and the trend of current changes that affects the enterprise. It helps estimating weaknesses in the operating cycle, financial health, and future position of the business. And then for the disadvantages, it may be misleading if frequent changes have been allowed in principles and procedures over the period. So when you are doing comparative analysis, maybe for your own company, and let's say in 2020, the principles or the conventions you followed in preparing your financial statements are different from the ones you use in the subsequent years, it will make comparison very difficult, and it might be misleading because the changes can be as a result of the changes that were made in subsequent years. Also, without the knowledge of internal analysis, it may be extremely misleading. It does not show the relation of any item to assets or to liabilities or to total net sales in a year. Also, proper comparison between two or more firms cannot be possible by this statement because there is no common base of comparison. So before you undertake comparative financial analysis with another company, you have to do your checks to know whether what you are doing or your ways of doing things are similar to the company you are comparing yourself to. If not, the comparative analysis you are doing will be fruitless. So illustration of comparative analysis. So this is the question for Cancam Company Limited, and we are required to prepare. Yes, Mohammed.
Please, madam, I want to find out maybe in terms of intercompany comparison, comparing two or more companies, knowing very well that the nature of business they run varies, and then the capital required also varies. Can we use those two or more companies to do comparison?
So mostly when you are doing comparative analysis, you do it with the companies in the industry you find yourself. So if you are in the manufacturing industry, it is advisable to compare your firm to, how do you call it, a firm in that industry. And mostly the comparative analysis, the company does it. So that they will restructure their strategic management decisions and all that. And the various stakeholders, if they want to invest in a company, they do this comparative analysis to see where they can invest in. So it's always advisable to compare your company with somebody you find yourself in the same industry with. It is easier that way. And in their annual reports, they make certain disclosures, so you know whether the two companies you are comparing are similar or not. Mohammed,
Thank you.
I don't know if I've answered your question.
Yes, please. Thank you, madam.
You're welcome. Okay. So for Cancom Limited, we'll do a comparison. Hey, who is that? So we have the net sales here, less cost of goods sold, gross profits margin, gross profits, administrative expenses, selling expenses, advertisement expenses, and all that. And we want to make a comparative here. So here, what we do is that for comparative analysis for Cancom Limited, first you'd have to calculate the increase or decrease in absolute terms with the figure itself. And then secondly, you calculate the percentage increase or decrease. And then to make the comparison, you always use the last year? I don't know. You use, so in our case, it was for 2016 and 2017. So we'll use 2016 as the base year to enable us compare between these years. So to compare for net sales, what do we do? It will be, so to compare net sales for 2016 and 2017, since 2016 is the base year, the percentage increase will be 100%, but then we can track the changes when we compare it using 2017. So for the net sales for 2016, what is the figure? I want you guys to contribute here. What is the figure for net sales? Please, who is speaking? Mohammed, yes.
Please, the figure for 2016 for net sales is 170,000.
Okay, so it's 170,000. And because 2016 is the base year, we'll divide it with the same 170,000 times 100%. So in the end, all the values for the base year will be 100%. Please, do you get it? That's for
Yes, ma'am.
2016. But then when we move to 20, okay. So then when we move to 2017, it will be 190. I can't see. Okay. It will be 190,400 divided by the base year. That's 170,000 times 100. Please, what do we get? Hello, are you following? What do we get? Please, you have calculators.
112. 112.
112. When you when you divide 190,400 over 170,000 times 100, you get 112. Ah, wow.
Yes, madam.
Hello.
Yes, madam.
What did you get?
Madam, Please, I'm a bit confused because
Someone is saying
I,
1-1. I want you guys to,
yes, I
yeah,
want, Madam,
It's
I'm
one
a
one
bit
two.
confused because I,
1-1-2.
Madam,
Yes, I'm listening.
please, I'm a bit confused because I think earlier maybe we would have subtracted the this in the net sales of 2016 from the net sales of 2017, whether we get a decrease or an increase, and then maybe that
Oh,
thing,
okay,
the
okay,
difference, then we
okay,
divide it
okay.
by
Is it
the
Awal or
previous
Sandra?
year
Thank
and
you.
then multiply by 100.
Yes.
This is Awal.
Supposed to get 24,000 something. So what's the difference between 190,400 and 170,000?
Exactly, that is 2,400, 20,400.
That's why I was not convinced of the 112. 20. Hello. Hello. What's the figure? I'm not calculating here, so I
Twenty
want you
four
guys to
hundred.
calculate. What's the difference?
2400.
2,400. Is it an increase or a decrease? Ankara, is it an increase or a
It,
decrease?
it has increased from the previous year.
It has increased, madam.
Okay, so okay, now we would find the percentage. So the 2,400 divided by 170,000 times 100, what do you get? Hello? Hello?
The answer is 12.
The answer is 12.
Yes, please.
So the absolute value for net sales is 2,400, and then the percentage increase is what? Is it 12%? Hello?
Yes, madam.
12.
It's
Then we
12%.
move on to, okay, thank you. Cost of goods sold. What will we do for cost of goods sold? So the first thing is to find the difference. So 105,000 less 120,000. Is it an increase or a decrease? I won't calculate here.
It's
You
an
guys have to
increase.
speak. It's an increase of what amount?
It's an increase of 15,000.
15,000.
15,000. So then
Yes,
you
please.
divide it with the figure for the base year, which is 105,000 times 100. What's the percentage?
Madam, we'll get 14.285.
14.285.
Yes.
14.285. So it is 14.3%, right?
Yes.
Okay, madam.
Please, are you following? So that's how you do the comparison. You compare it with the base year. So we are in 2017. We want to see how maybe in 2016 you got 170,000 in net sales, and then in 2017 you are getting 190,400 in net sales. We want to know the increase. Is it an increase or a decrease in absolute terms as well as in percentage terms? Because sometimes the percentages, as we identified earlier on, can be misleading. Let's assume your net sales figure for 2016 is 50 Ghana cedis. 50 Ghana cedis. And then for 2017, you get 100 Ghana cedis. You know, in percentage form, you get, is it What would be the percentage? 100 minus 50 over 100 times. What would be the figure? Hello? Hello? I won't calculate it. I want you guys to calculate, and you're not talking. Where is Awal? Awal was
Please,
talking, and there's
the
another
figure.
Madam. Yes, ma. I'm here, sir. Madam.
guy. Okay. A lady was speaking, Sule Arahamatu. You said, what would be the percentage?
Madam, please, are we
Yes.
on which item, please? Looking at the items, it seems I'm lost. We are in which item? Is it administrative or?
Okay.
I didn't get it.
Please, madam.
I was explaining that you need the when you do the comparison and you get the absolute figure, be it an increase or a decrease, the figure might be less low, but then the it might make it look very huge. So to do your comparison, you need both the figure in absolute terms and in percentage terms. And I was making an example earlier on that when net sales is say 100 cedis and then it increased to 200 cedis, in percentage terms, we'll say there's 100% increment, right?
Yes, madam.
There's 100% increment, but when you look at it practically, you can see that it has just increased by 100%. But let's assume that the sales was maybe 105,000 cedis, and then it increased to 200,000 cedis. What would be the percentage change? Let's assume the percentage change is say 20%. When you see the 100% for the 100 and the 200 cedis that we got, you think it is more than the 105 and the 200,000 cedis. So that's why you always need the difference, that's the increase or decrease in absolute terms as well as percentage terms, because sometimes the percentage might be misleading. You can see 50% increase in the item you are looking at, but maybe it's outrageous. Maybe it's increased by just maybe 10 cedis or 20 cedis. So that's what I was establishing. I don't know if I'm making a point or I'm confusing you. Any question at this point? Hello?
Yes, ma'am.
Do you get it? You were confused. I don't know whether I've made my point.
Oh, I understand, ma'am. Thank you.
Okay, so you do same for the others. So let's do for gross profit. What's the difference between 65,000 and 70,400?
5,400.
5,400.
400.
5,400. So when you okay, thank you. When you want to find it in percentage form, it will be the 5,400 divided by the figure for the base year. What's the figure for the base? Okay, 65,000.
65,000.
Okay, times 100. What do we get here?
8.307.
So 8.3%. So you do same for all the items here. So from the calculations, the third column is what? Amount of increase or decrease. Hello? And then here is the percentage increase or decrease. So you can see here that net sales increased by 12%. Cost of goods sold increased by 14.3%. Gross profit increased by what? 8.3%. Administrative expenses increased by 13.3%. Advertisement expenses increased by 33.3%. This is alarming, meaning that the increase in sales here was due to this advertising. So they increased sales, all right, but it didn't really reflect in their profit here. Hello.
Hi.
So the number of units they sold increased, but they didn't really see it in profit terms because their expenses was high. And then other selling expenses was 2.5%. We have total selling expenses, which increased by 4.6%. Operating expenses was 6.6%. Operating profits 20.5%. And then we have other income. You see, other income is huge here. Can you see 43.8%?
Yes.
Ordinarily, a company would want their operating profit to be higher than other income because other income is temporal income. It does not come consistently. It is temporal, but for the operating income, you know that by hook or crook, you get profit from there. So it is advisable for your operating profits to be higher than other income because in the year 2017, other income has increased by what will happen in 2018. Then we have other expenses, which is 29.4. Then we have profits before tax. So you can see that the profit before tax is huge due to the what? Other income. Then we have income tax here. It's also increased. And then we have profit after tax. Hello. So for the interpretation, we can see that CAM Company Limited recorded an increase in sales, which we have all witnessed to in 2017. The cost of goods sold increased at a higher rate, resulting in only marginal improvement in what? Gross profit. So we also advertising expenses, meaning that for them to increase their sales, they had to invest more in advertising, which suggests that sales growth was achieved through increased promotional efforts and possibly price reduction. The substantial increase in profits was largely due to higher other income, which is mostly temporal, and lower other expenses, indicating greater reliance on non-operating profits rather than core operating performance. Please, any question? Are you good? Do you understand? Yes, Mohammed.
Madam, so in this case,
Mohammed.
considering, yes, please, Madam.
Hello.
So in this case, looking at the percentage increase in the net sales
Mohammed.
as compared to cost of goods sold, that is the net sales percentage increase is 12%. And then the cost
Okay.
of goods sold percentage is 14.3%. Can we say we are
Yes.
efficient?
Can we say we are what?
We are efficient in running the business. We are
Remember
running the business efficiently.
remember the cost of goods sold also encompasses the cost you incurred in production.
Okay.
Like
Thank you, Madam.
the materials you consumed and all that. So it might not be as a result of the sales you made, but because much went into the goods you are selling through promotional activities and all that. Ah, wow.
Madam,
Are we okay?
we
Yes,
are together,
Awal.
Madam. We are
Are you
together.
okay? Can I any other person?
Hikma is here.
Who?
Hikma, she's here.
Hikma. Oh, okay, you
Yes.
are sharing your machine with someone else.
That she understands. I thought she was having a question.
Okay, so we can proceed. So meaning that they rely more on non-operating profits rather than core operating performance. Then we'll move on to common size analysis. Yes, who helped me? Common size analysis. Common size analysis. Hey, where are my Botek? Today I'm correct. Where are my Botek people? Botek. No,
Madam
Burger Tech.
yes, Joseph and the colleagues are here.
Joseph, you are from Botek.
Joseph and the colleagues were here. Yes, madam.
Okay.
We are all here.
Okay, so hey, and you've been making only Joseph speak. All of you, the Botek people. Where is hey, I've forgotten her name. Monica. Monica was not active last week.
Monica just excused us. She just excused us and said she had an emergency at home.
She will excuse herself. Oh,
No, that she had an emergency at home.
Okay, and there was another man. I've forgotten his name.
Nashiru.
No, another name. And where are my Fiasiman? Thank you, Joseph. Where are my Fiasiman people? Fiasiman. Is anyone from Fiasiman here? Hey. Wow.
Madam, we are here.
Hello, madam.
Eric from Fiasiman. Eric.
Oh, I'm from Tamale Center.
Oh, Tamale. I was about.
We are
Tamale.
many. Somebody here, Mr. Akidam, Hikma, Emmanuel,
And
then
Libby. You are not talking. You are not
Hello.
contributing to the class. Tamale, you are not contributing.
Madam Abba, we are.
So please, you are coming to do common size analysis.
Let me give it to them, madam.
Madam, good afternoon.
Yes.
Yeah, please, this is Somen speaking.
Awa, are you from Tamale?
Yes, we are all together.
Yes, we are from Tamale.
Oh, yeah. Awa has been active today. Who is speaking now?
This is Somen speaking, sir. We are in a group, so we normally contribute together.
Okay.
And that is how we normally do. Thank you, madam.
Okay, you're welcome. I'm checking on my. There's another group. Wa group.
Where is
There's no one from Wa here.
Somebody's where? Sansan is from where?
Okay. Sansa has spoken today. Ankara has spoken today.
Sure.
Okay. Then we have okay, Fiasiman. Nobody has spoken today. Fiasiman, when we say common size statement, what comes to mind? Who is from Fiasiman here? Hello.
Albert Abuchi.
Abuchi, you are from Fiasiman. Hello, Abuchi.
Yes, madam.
So when we say common size analysis, what comes to mind? Yes, Abuchi, I'm listening. Common size analysis. Who is also from Fiasiman? I won't be the only one speaking here. I need you guys to talk. Fiasiman, Mumuni.
Yes, madam.
Mumuni.
Yes, madam.
Are you from Fiasiman?
No, I'm in Tamale.
Okay, okay. Okay, but you want to help, right? Okay, what is
Yeah.
common size financial statement or common size analysis?
Yeah. So the common size analysis, no, we look at we find one particular common factor. Let's assume sales in the
Okay,
statement. Then we refer almost all the factors to sales. So let's assume if we run the sales to 100%, and we compared all the activities within the year to the sales. So that means,
okay,
per my understanding, if you are using the statement of financial position, you look at a common factor in the statement of financial position. Then you
and you
run
use
all
that
the
as a
activities.
base.
Yes.
Okay, okay, okay. Mumuni, thank you from Tamale Center, right?
Yes, please.
Okay, thank you. So, as your colleague said, common size financial statements is a restated financial statement showing percentage of total items with a common base. The emphasis here is what? Common base for comparison. And another name for common size financial statement is what? Common size analysis is vertical analysis. The statement is made in the following procedure. Assets side is classified into non-current assets and current assets, showing individually and in total. The total assets are taken as the common base. So when you take any item from the non-current assets, you use the total assets as the common base, and then you multiply with 100% to get your figure. Then for the liabilities side, it is classified into non-current liabilities and current liabilities, showing individuality and totality. And the percentage of each liability is towards total liability. So income statement is classified into sales, cost of goods sold, operating expenses, net profit, interest, tax, earning after tax, etc. So then the percentage of each item to sales is calculated. So in the income statement, the base will be the sales. Hello. The base will be the sales. So what are advantages of common size analysis? What is that it shows changes over the years in relation to total assets, total liability, or sales. It helps in inter-firm comparison with a common base. It helps in vertical analysis of figures. It helps in understanding financial strategy of the firm in comparison, and it shows the relative efficiency of each cost item of the two firms. When we move on to the disadvantages, it shows the percentage of each item to the total in each period, but not changes of each item from period to period. Its observations are not useful because there are more definite norms for the proportion of each item to the total. If there is no uniform costing system, no same accounting practices among all firms of an industry, then it's meaningless for studying the comparative financial position. So as we've established over and over again, when you are doing comparison with another industry, you have to find out if their principles, their costing system, are they using LIFO, are they using FIFO, are they using absorption costing, and all that. You have to know what they are using. Is it similar to yours before you go ahead with a comparison? So we have another illustration here. So illustration of common size analysis. Which company is this? From the following income statement, prepare a common size statement and also interpret the result. So here in the income statement, we have net sales, profits, other operating expenses, operating profits, interest on long-term debt, and profits before tax. So what's the base here? What base do we use for our comparison? Who will help me? What base will we use for our comparison here? Yes, Joseph.
We use the net sales. Net
Okay,
sales.
that's meaning you were following. We use the net sales to do our comparison. Here, you see, since the net sales is the base, automatically is 100%, 100%. So for cost of goods sold, it will be the cost of goods sold figure, which is what? What's the cost of goods sold figure? People. Cost of goods sold figure.
570,000.
Yeah. The figure is on the slide, though. Hello. 570,000.
Madam, is it 570 or 510?
Oh, sorry, I think 570. What is the base? I want the figure. For 2016, we are doing for 2016. What's the base? We are using the net sales as the base. So what's the base for 2016?
1,050,000.
Figure. When we multiply it by 100, what do we get? Are we getting this figure? Punch it on your calculators. Hello. Hello. Oh, let's move.
Hi.
Oh.
Yes, Abochi. Joseph is the only one talking. Where are the rest?
Madam,
Abochi.
I got 54.28.
Yes, Abochi can speak.
Please, madam, we are around.
I'm asking a question. Hello.
Madam.
Yes, Abochi.
Madam, I got 54.3.
54.3.
Yes, madam.
Okay. And then for 2017. For 2017, the base will be 1,350,000. So it will be 645,000 divided by 1,350,000 times 100. What are we getting for 2017? For cost of goods sold. Hello. Hey, you people, where are you?
Hello, madam.
Madam, you get
Yes.
47.8.
47.8. So you do same for, let's do for gross profit. So for 2016, what do we have? How will we calculate for 2016? You're not minding me. Let me move on. I should move on. Thank you.
Madam, sorry.
So for cost of goods, oh, don't worry, I'll move on. So for cost of goods sold, it's cost of sales minus the base. That's the figure here. The formula is here. If I don't go through with you and you see the formula, you use the wrong figures to calculate it. That's how I was taking my time to go through with you. But so for gross profit, it will be gross profit over net sales times 100%. You do for 2016 and then for 2017. And you do same for all the variables. So for the figures here, how can we make our interpretation? So cost of goods sold from 2016 to 2017, was there an increase or a decrease? Ah, wow.
Madam, please, there is an increase in the cost of goods sold from 2016 to 2017.
What does it tell us?
Madam, it means we've incurred maybe a percentage change in the cost of goods sold, maybe in the subsequent year. Sorry,
Okay,
2017.
in 2017. And we
Yes,
can see here too that gross profit, the other people, they are not talking. Where is Bumper? The people, you are quiet. Now when I talk, Benedicta will bring a thumbs up. Benedicta and co. Benedicta. Bumper, today you guys are not speaking at all. But you give me thumbs up.
We are speaking.
Yes.
But ours is
Okay. Okay. So gross profit, has it increased or decreased? Bumper.
but that increase.
Please, who is speaking?
But
You are many, so I wouldn't know who is speaking. Hello.
NH.
Who? Benny. NS, you've not spoken. Okay, is it an increase or a decrease?
Times madam increase.
Increase. So what does it tell us? What is the interpretation we can make? What does it tell us?
Madam, it means that in 2017 we make a huge revenue than in 2016.
Okay. And then the next item is other operating expenses. Is there an increase or a decrease? Delegate. Some people, they don't talk. Elizabeth.
Madam, there's an increase. Oh.
There's an increase. So meaning, what interpretation can we make here?
Meaning they made extra expenses during the year of 2017.
Elizabeth.
Yes, madam.
They made what?
They incurred more expenses in 2017 than 2016.
So is it a good thing or a bad thing?
Madam, it's good because the expenses that they made them to generate higher income. Looking at the gross profit.
Okay. I can see Evans. UCC.
Please, madam, some of us are not seeing your slides. Hello, please, madam.
Hey.
Some of us are not seeing your slides.
Please, who is speaking? Hello.
Hi, madam.
Please, the other people, can you see my slide bumper?
Yes, please, madam, we can see. It's their network. Please, madam, we can see.
Hello.
We can see the slide.
Okay. Okay.
Their network is not that stable, that's why. So they should get 5G.
Okay. Okay. And then operating profits. Was there an increase or decrease?
Hang on.
Bumper center. You guys are making noise. Bumper. Please behave yourself. Bumper.
What should you say that operating expenses increase in
Bumper.
Madam. Madam, I raised my hand. No.
Yes, please. Who is speaking?
Madam, this is
Mumuni, yes.
So, madam, my
Operating profit.
concern. Oh no, madam, please. I wanted some clarification here, not on the operating profit.
Okay.
So, at the cost of goods sold, we have it in 2016 as 54.3% and 2017 47.8%. And Mr. Awal let us understand that there is an increment inside of it.
Mm-hmm.
And going to operating expenses, it is also a cost. And we have it in 2016 as 14.3% and 16% in 2017. And they are also saying that there is an increment inside of it. So I want some clarification about that one.
Okay. Hello, about what? You just mentioned the items. You want clarification about?
So I'm saying, looking at the percentages attached to the various costs. Hello, madam.
Of what? You want you want classification on what?
So I want a further understanding about why is it that the two are having less the cost of goods sold, or the cost of sales in 2017 is more 47.8% compared to 2016, which is 54.3%, and we said there is an increment, and the operating expenses too is 14.3% and 16% in 2017, and we also say there is an increment inside of the cost. So I want the understanding of it very well, please, because I am looking
for the other operating expenses.
Yes, the other operating expenses. If 54.3 against 47.8, I would say maybe there is a decrease inside of a decrease, and operating expenses 14.3% and 16%, maybe there is an increase. So I want explanation why the 47.8% is an increase in the.
So when you have 52, 52.2 and 45.7, which one is greater and which one is lesser?
The 54.3% is greater than that of 54.3 is greater than 47.8.
Which figure are you talking about? Is it gross profit or what? Are you talking of gross profit or cost of
on the cost of sales? On the cost of sales.
Okay. Okay, okay. Okay. It was 54.3%, and then 48%. Cost of goods sold are the cost you incur in production, the materials you consume, cost of raw material, labor, manufacturing cost, and all that. So if it has reduced, it is a good thing, meaning that the goods you are not spending much on the goods you are producing. Hello. So when it decreases to 47.8, it is a good thing. And then you are saying that other operating expenses has increased by 16%. Other operating goods sold. So any other expenses has increased, but the cost of goods sold has decreased. So that's it. I don't know if I've answered your question.
The first explanation has misled us. That's why he was asking. Because the first person said it was
Which
rather an
person?
increase, which I mean, Mohammed Awal, he
Oh,
explained earlier that it was an increase. I think that's the reason why he's asking that question.
oh, okay, okay. But you get it now. If cost of goods sold has decreased, it is a good thing.
Madam, my hand is up.
Let me address Mumuni. Mumuni,
Hello,
if it has
madam.
decreased, meaning it's a good thing. Yes, are you okay?
Yes, yes, I'm okay with that.
Yeah, okay now. Yes, the
Yes.
next person. Benedicta. Hello.
Benedicta, I've removed.
Please, madam, we can't hear you.
Hello. Pardon me, my network.
Hi.
Hello.
Yeah, hello, madam.
My network. Pardon me.
Madam,
I
please. Hello, madam.
Yes, please, who is speaking?
This is Awal.
Okay,
Tamale
Awal.
Teka. Yes.
Okay.
Madam, Mumuni just threw a question on both the gross cost of goods sold, that is cost of sales, relating it to other operating expenses, or rather,
Okay.
operating expenses. And looking at it
Okay.
earlier, I said the company, this thing, it has increased the company, there is a reason, because my reason was that 2016, looking at the percentage relating to cost of goods sold, it was 54.3%. That is in 2016. Now in 2017, it has reduced to 47.8. So logically, it has reduced the cost of goods sold in the firm. So it is an increase to the firm. Hello, madam.
Yes, I get you.
Yes. Now, when we come to the other operating expenses, I think there is an increase there. Sorry, there is a decrease rather, because initially in 2016 we incurred in percentage-wise 14.3, and then now increased to 16%, meaning there is a decrease logically. So my point.
So what I'm getting is that Mohammed is explaining using the indirect form, like how it will benefit the company. But maybe he wanted you to say that it has decreased cost of goods sold, and then go ahead with your interpretation. Please, you get it. Wow. It doesn't mean you are wrong. Your explanation is right.
Thank you, madam.
Okay. Any other question? Benedicta, your hand was up. Okay. Okay. So thank you. This shows that you are all following. So for the interpretation, the common size income statement revealed that the profitability of the company improved, which we have agreed with. Cost of goods sold and interest expenses declined as a percentage of sales, indicating cost control and reduced financial burden. As a result, profit before tax increased significantly. Profit before tax, okay, from 25.7 to 32.4. It increased significantly, reflecting improved operational and financial efficiency. So is the company doing well as compared to 2016? Hello, my people.
No, man.
Hello, madam. Abochi, are you here?
Hello, madam.
Is the company doing well? Yes, Ivan.
Yeah, please, madam, we are there. Madam, I have a question to ask.
Okay. Is the company doing well? Yes, Evans. Evans, we are listening. Hello. Can you hear me? Well, can you hear me? I don't know if my network
Yes, madam.
is stable. Okay, thank you. Evans. We'll move on to trend analysis. Yes. Evans.
Please, madam, your network is very bad.
Help me.
Your network is very bad, madam.
Hello. Take. Hello, Evans.
Madam, you saying your network is very bad.
Analysis studies behavior of individuals. Sansa, can you hear me?
I can hear you, but the network is breaking. Yes, madam.
It's breaking.
Yes, please.
Oh, okay. I'm in a village. I'm in a village.
Madam,
so is it better now? Can you hear me?
Yes, please. Yes, please.
I'm in a village. My network is bad. Is it better now?
Wait, madam, wait.
Why do you want to know my village? Nashiru, can you hear me?
Yes, madam, I can hear you. I was just saying that if you could readjust your screen to take off the
My
editing,
screen.
the drawing tools, so that it could look larger for some of us. The drawing tools, I don't think we don't need that, and then the slides at your left. So if you could adjust the screen.
Okay.
Thank you.
But when I adjust my screen, I wouldn't see your names, and it will make it difficult for me.
Yes, what I was just saying is that, sometimes you can project without the drawing tools coming, and then the side slides coming. So that way,
When I go to the, I'm coming.
Yes, because some of us struggle to see, especially when the table with the figures. I mean, it's.
Is it better now?
Yes, madam. Yes, madam. Thank you.
Now when I'm coming. Now see your names, and it makes, I'm coming. A moment, please. I think I'll manage here.
Okay.
Okay. Is it better now?
Yeah, thank you.
You know, when you go to slide modes view, I can't see your names, and it will be difficult for me to interact with the class.
Well noted.
Please, who was speaking? Nashiru, I'll do the slideshow for you. Nashiru.
Okay, madam.
Okay, I have your names off head, so okay, I'll manage. So when we say trend analysis, I'll manage, because I want you to see. When we say trend analysis, what comes to mind? Nashiru, I'll ask you. Nashiru, from which center?
Nashiru Botek. Madam, I'm not even able to join. I'm not even able to join. No. So I honestly, please, if you can pass it on.
Okay.
Thank
Who will
you.
help? Awal. I know of Awal, Abochi.
Madam.
Mention your name. I'm on slide mode, so I can't see your name.
Abochi.
Okay, Abochi. When we say trend analysis, what comes to mind?
Madam, it's about studying the financial statement of an organization for some years, and seeing the trend in the behavior of the items in the financial statement.
Okay. So when you do that, what happens? What are we seeking to achieve through trend analysis? Who will help me? Abochi, thank you. Jennifer. Abochi, do you want to answer?
Madam, let me try.
Please, who is speaking?
Abochi.
Okay, Abochi.
You try to identify whether there is an increase or decrease in the trend, or is stable.
Okay. Okay. Thank you. Hey, Abuchi, are you explaining or you are reading from the slide? So as Abuchi said, we undertake or we undergo trend analysis to study the overall behavior of items in the financial statement to know the trend, whether there's an increase, there's a decrease, or it's constant or it's stable over time. Generally, we conduct it over a long period of time, say 5 or 10 years. You see the previous one, the comparative analysis and the, how do you call it, the vertical analysis, the horizontal analysis and all that. We were comparing it using 2 years or so. But with the trend analysis, you'd have to undergo this analysis for say 5 or 10 years. And the trend analysis are calculated taking a base year as 100 and expressing subsequent years as a percentage of the base year. And we look at only the major items to highlight significant changes. And mostly the base year is usually the earliest year, but another year may be selected depending on economic, political, or business condition. So for the trend percentage or ratio, it is value of each item in the financial statement of any period over value of the same item in the financial statement of the base period plus 100%. So in calculating the trend ratio, you have to follow these. That is, the uniform costing system should be followed from year to year for horizontal analysis. So as I said earlier, if you are using LIFO, you should use LIFO throughout. If you are using FIFO, you should use FIFO throughout. The accounting principles and practices should follow consistency convention throughout the period of analysis. Without such consistency, the comparison will be adversely affected. Please, can you hear me?
Yes,
Yes,
madam.
madam.
Or you feel
Yes, madam.
you can hear me? Okay. Okay, the base year should be the normal year, which is representative of the items shown in the statement. Trend percentages should be calculated only for items having logical relationship with another. Trend percentages should be studied after considering the absolute figures on which they are based. Otherwise, it's from 100 cities to 200 cities, while other expenses may increase from 10,000 to 15,000. You see here, the trend percentage will show 100% increase in the first case, and then in the second case, this is misleading because in the first case, the change was 100%, but it's not that significant or meaningful. It's not that huge as compared to moving from 100,000 to 15,000. So the figures for the current year should be adjusted in light of price levels as compared to the base year before calculating the trend percentages. So you have to adjust for inflation and all that before you calculate the trend percentages. So trend analysis is powerful, but only if the data being compared is truly comparable. So you, the analyst conducting this trend analysis, you have to make sure that what you are comparing is what's truly comparable. So for the advantages of trend analysis, it shows the trend of items with passage of time. It shows the nature and rate of movement of various financial factors. It shows horizontal and vertical analysis to reflect the behavior of various financial items with passage of time. And also, it helps in estimating the financial factor in the future. Disadvantages. I think this is making it difficult for me because you guys have to bear with me. Slideshow. I can't see your names and it makes it difficult. I wouldn't know whether I've lost you or we are still on. So, isn't Ashiru? Pardon me. Pardon
Yes,
me.
madam. Yes,
So,
madam. Thank you.
thank you. Thank you, Nashiru.
Thank you
So
too.
for the disadvantages, I think this is better. Let me see. Is this better? Yes, Eric.
Yes. Yes, madam. Thank you.
Okay, this is better than before. I don't know how to minimize the ribbon.
Madam.
Yes, click there.
Thank you. So for
Madam.
the disadvantages, yes, Eric, you see now I can see your names.
Yeah, madam, please, will
Yes,
you be
Eric.
sharing the slides with us?
Yes, last week I placed my number on the platform, but I was only 2 reps who contacted me. A lady, Tamale Center, and a gentleman. Is it Tamale and Wa? Tamale and Wa.
Yeah, just,
The other reps.
just,
Hello.
Hello, madam.
Yes, the other reps did not reach out, Eric. It was only Tamale and Wa Center that reached out.
Okay. Please, can we have your contact so that maybe after the class we link up?
My contact is on your page.
Okay, madam. Thank you.
But let me place my WhatsApp number. Hey, message. So the reps kindly contact me after the class 020. Hello, this is my number, so the rep should contact me after the class. Is that okay, Eric?
Please, madam, give out the number.
Yes, ma'am. Yes, ma'am. That's okay. Thank you very much.
Okay, you're welcome. So for the disadvantages of trend analysis, if there is no uniform accounting system year after year, then the trend ratios will give meaningful results, which we have established earlier. Also, it does not take into consideration the inflation accounting system. So figures of the base period are incomparable with figures of the current period in case of inflation. Trend ratios must always be read with absolute data on which they are based. Otherwise, the conclusion drawn may be misleading. It may be said that a 10% change in trend ratio may represent an absolute change of 1,000 only in one item, while a 10% change in another may represent an absolute change of 100. So it's good to make comparison using the figures in absolute terms and then the percentages as well. Illustration of trend analysis. So we have, so compute the trend ratios from the following data and comments. So cost of material, we have for 2014 through to 2017. So we have cost of materials consumed, labor costs, other expense, cost of sales, profits, and then what? Sales. And in the computation of the trend ratio, assuming a base year to be what? 2014. So since 2014 is the base year, all the items for 2014 will be 100%. So when we come to 2015, it will be the value of the item in 2015 over the value in 2014 times 100%. So when we come here, it will be for cost of material. Hey. So for cost of material consumed, 2014 is the base year. Everything here will be 100%. For 2015, it will be 250,000 divided by 200,000 times 100. What will you get? Eric.
Yes, madam.
What will you get?
Hello,
250
madam.
divided by
Yeah,
200,000.
250 divided by.
Hello.
Hello, madam.
200,000 times. Yes, Eric. What will you get?
Madam, please, your line is not stable, so I didn't hear you clear.
Can you hear me now?
Yeah, now I think it's clear.
Okay. I'm saying that for cost of material consumed, for 2015, it will be the value of the item, 250,000 divided by 200,000 times 100. What will we get?
So,
Eric, who is
madam, please, the
speaking?
answer will be 1.25. Madam, please, this is Eric.
1.25.
Yes, please.
Okay, Eric, thank you. And for 2016, it will be 200,000 divided by 200,000 times 100, which is 100%. And then for 180, what is it? 180 divided by 200 times 100. What are we getting? You see, bumper center is quiet too. Bumper, where are you? 180 divided by 200,000 times 100.
180.
I was speaking before. Okay, so for cost of material in 2015, we got 125. 2015, what are we getting? 100. 2016, 133.3, 83.3. Other expense, 133.6.7, and then 100. Cost of sales, 120, 191. Profit, 115. Sales, 112.5, 93.8, and 100. What comment can we make here? You can see that for cost of material consumed, it increased in 2015, reduced, and then reduced further in 2017. For labor costs, it was stable from 2014 to 2015. They didn't see any significant increase, but in 2016, it increased by 33.3%. But then in Esmond.
Madam,
Hello,
please, this is
Esmond.
Summit. Yeah, please, madam, this is Summit.
This is
Summit.
who?
I'm sitting with
Okay,
Mr.
Summit.
Esmond. Yeah, madam.
Oh, okay. Yes,
yeah.
welcome.
Please, I want to find out about. You didn't say
we are
anything
listening.
about. I said you didn't say anything
Hello.
about.
Yeah, madam.
I didn't say anything. I didn't say anything about
Our presentation, our daily day. The group
your what?
presentation, our group presentations.
Your group presentations. It's not time for group presentation. Hello.
Thank you.
Which country are you from?
Somebody. Madam.
Tamale.
Hello.
Tamale.
When is time?
Hello,
I'll
madam,
let
please,
you
we can't
know.
hear you.
I'll communicate you. Hello.
You said, madam. Yeah, hello, madam.
When it's time for the allocation, I'll let you know through your program reps.
Thank you.
Is that okay?
Miss Elsie.
You're in your third week now. This is the third week, right? Okay. Eric. Hello, Eric. Whew. Please, can you hear me? Oh, wow, are you here? Someone called me. Who was that? Eric.
Madam, I'm there. Madam, I'm there.
Can you hear me?
Hello?
Someone asked
Hello,
the
madam.
question. Is it you, Eric? Yes, Mumuni.
No, this is not Mumune. This is Awal. My battery went off.
Oh, okay, okay. Oh, wow. Okay. So you can see it's fluctuating. It increased in 2015 by 20%. It reduced by 20 in 2016, and then it decreased further to 91 in 2017. So from the trend, we can see that it's fluctuating. Sales, for instance, increased in 2015.
Hello, please, can anyone hear me?
2016 compared to Eric.
How about you?
Hello, Eric.
How about you?
It increased in 2015 compared to the base year, but in 2016 it decreased to 93.8, and then for 2017 it was 100%. So for the interpretation, trend analysis with 2014 as the base year shows that most items, as we saw, fluctuated during the period under review. As we've seen earlier, cost of sales reduced in 2016 and 2017, mainly due to reduction in cost of materials consumed. Sale and profit did not follow a consistent trend, indicating instability in performance, and percentages above 100, as we all know, indicate an increase over the base year, while those below indicates a decrease. We move on to income. So income, as we all know, it refers to increase in economic. Yes, Eric. Eric, you can speak. Eric. We don't have much time. It refers to increase in economic benefits during the accounting period in forms of inflow or enhancement of assets, or decreases of liability that results in increases in equity, other than those relating to contribution from equity participants. So generally, we all know that income is denoted by different terms such as profit, net profit, or net income. In accounting, income is defined as excess of total revenue and over expired costs. Total revenue includes revenue earned from operating activities and gains from other incidental activities of the business, whereas the expired costs consist of expenses incurred for generating revenue for the business and losses from other incidental activities of the business. Yes, Eric. Hey, Eric. Which center is he from? Who is there with him? Hello.
Madam, let's make progress. I believe it's from his network.
Oh, okay. Okay, thank you. So, accounting concept of income can be mathematically expressed as follows. So, it is revenue earned from operating activities plus other incidental gains. Then we less expenses and other incidental losses. Then we move on to economic concepts of income. For economics, from the viewpoint of business or firm. But in economics, it is measured from the viewpoint of individuals, a group of individuals, or society in general. So accounting is from the view of a business, and then economics is from the views of individuals, group, or the society at large. Hmm. Oh, so various artists have defined the concept of income in economics. So according to Hicks, a man's income is to be considered as the maximum value which he can consume during a week and is still expected to be well off at the end of the week as he was at the beginning. So the economics computation of income is consumption of capital during the period plus capital at the end of the period minus capital at the beginning of the period minus fresh capital introduced during the period. So from economic standpoint, income is the difference between capital employed in a firm at 2 points in time. So for ascertaining economic income, operating and closing capital are to be taken at fair market value and not at historical cost. So for measuring income, for measurement of income, we have the transaction approach of income measurement. So under this approach, income is measured by deducting relatively expired costs or expenses from the revenue out of the transaction. This approach considers the business transaction as the main tool for measurement of income. The approach as a result of transaction. Under this approach, revenue and gains arising out of transaction are considered on realized basis. And still, under the transaction approach, expired costs arisen out of transaction is also taken into account. Income is measured by matching the total revenue realized during an accounting period against expired costs allocated for that period. So the mathematical computation for income under the traditional approach is revenue earned from operating activities plus other revenue gains minus expenses plus other revenue losses. So your total revenue minus your expenses. This approach of income measurement is most popular and widely used. Also, we have statement of financial position approach. So here, income is measured by net change in net assets of the firm during the accounting period. Net increase in net assets between two statements of the financial position dates of the firm is measured as the income of the firm for that period. Net assets refer to total assets minus total liabilities. And for this purpose, assets and liabilities are valued at their change in net assets of the firm for measuring income. Adjustment is also made for fresh capital introduced and withdrawal of capital, if any, during the period. And the mathematical computation is net asset during the period. So the mathematical computation is net assets at the end of the period minus net assets at the beginning of the period plus withdrawal of capital during the period minus introduced during the period. So under the statement of financial position approach of income measurement, the main emphasis is given on principle of capital maintenance. So here, income is recognized when capital increases. Ajua. Ajua. So analysis of income. Different phases of income may be analyzed as follows. So net sales, you get gross income or gross profit, you less operating expenses, you add operating income, net operating income and gains, you less non-operating expenses and losses, you less earning or profit before interest and tax and interest on debt, you less earnings or profit before tax and income and tax, you less earnings, profit after tax and preference dividend, and then you get your earnings, profit available to equity shareholders. Analysis of changes in income. Factors responsible for changes in income. So for all or any of the following reasons, income of the firm can change. So when sales volume increases, when there's an increase in the selling price, and when there's a decrease in the unit cost price, reduction in waste and efficient materials control. And then factors responsible for decrease in income are decrease in sales volume, decrease in unit selling price, increase in unit cost price, and increase in waste and inefficient material costs. Concept of revenue. So revenue is defined as actual or expected inflows of cash and other assets or reduction of liabilities resulting from normal or operating activities of the business. According to IAS 18, revenue is the gross inflow of economic benefit during the course of ordinary activities of an entity when those inflows result in increase in equity, except increases relating to contribution from equity participants. Recognition of revenue. So here, the seller of the goods has transferred the property in the goods to the buyer for a consideration called price. consisting wholly of and reward ownership has been transferred to the buyer. No significant uncertainty exists regarding the amount of consideration that will be derived from the sale of goods. The seller retains no effective control of goods transferred to a degree associated with ownership. The goods has been delivered to the buyer, either actual or constructive industry. So this is recognition of revenue by an enterprise. So when you want to recognize revenue by an enterprise, these are the conditions that must be in place. It is crucial to note that different industries may have variability in revenue recognition, and it may also vary from one country to another. Retail companies typically recognize revenue at the point of sales. Equipment manufacturers recognize at a point of shipment. Oil and gas companies recognize from the sale of crude oil prior to extraction, and companies producing goods or services under long-term contracts frequently recognize revenue on a percentage of completed work basis. In Ghana, contractors are paid on percentage of work completed, whilst in Japan, revenue recognition is usually delayed until a contract is completed. When evaluating the revenue recognition of a company, regardless of its natural reporting origin, it is always wise to begin by comparing the policy in use to accepted industry norms. Then we move on to expenses. It refers to decrease in economic benefit during the accounting period, outflows or depletions of assets, or incurrence of liability that result in decrease in equity other than those relating to distributions to shareholders. Gains refers to the net income received from incidental activities of a firm. In other words, gains refers to surplus arising from an activity of a firm other than its operating activities. Then, loss may be defined as the part of a spared cost from which no benefits can be derived from generating revenue from the incidental activities of the enterprise. So losses should not be mixed up with operating or trading loss. Losses arise from other incidental activities of the company, and it is not from operating or normal activities of the business. Losses is just the reverse of a gain. It is an expired cost, but unlike expense, loss do not help to generate revenue. Loss on sale of loss, discounts allowed, increase in provisions are some of the examples of losses. So this brings us to the end of Unit 3. Any question? Joseph?
Thank you for the. Mine is not a question, but a suggestion to the class and yourself. We've been doing something as a group. We always create WhatsApp, one common platform, and include the lecturer in that particular platform, so that whatever material they have.
Someone said it last week, but they didn't comply.
Yes,
Joseph.
so I'm just suggesting. Yes, madam. So
you
I'm
can
suggesting.
talk to your colleagues about it. Hello.
So yeah, hello.
Joseph, you can
Yes,
talk
madam.
to your colleagues about. I've placed my number here, so whatever you guys do with it.
Okay,
Any question? Someone raised the same concern last week. That's why. Any comment, question, contribution? So the reps, kindly contact me. Eric, I know you're a rep for. Is Eric here? Eric Atifu. Joseph,
yes,
are you
madam,
a
I'm
rep
here.
No,
Are you
madam.
a rep?
Madam, please.
No, madam, I'm not a rep.
So tell
But
your
yes,
okay. So tell
who,
your reps to contact me.
okay, I was suggesting that, madam, we just let our online rep to create this thing for us. There's an online rep here. She's called Lisbeth. She could create one and just add you and add everybody. Then we are good to go. But as for the reps, most of them, when they get materials, it takes long before we get them. That's why we want to have a common platform. Thank you.
Oh, I can't hear you. True that. Have a lovely weekend. Hello.
Thank you, madam. Same to you.
If yes, man, are they here?
Yes.
How about you? I see you. It's Jennifer.
Next time for do
Today,
this.
Jennifer did not attend class. Bumpy. You have a lovely weekend.
Thank you, madam.
Thank you, madam.
Thank you.
No, wait, I can't say that.